Welcome to another podcast of the Riffle series. The Riffle app podcast series brought to you by 10 Leaves. Today we're doing a really critical deep dive. We're looking at regulations that are, well, frankly, setting a global benchmark for market integrity. These are the rules coming out of the Abu Dhabi Global Market, the ADGM, and specifically, we're getting into the nitty-gritty of the ADGM Financial Services Regulatory Authority's Code of Market Conduct.
Yeah, and what's really striking about this code, right off the bat, is how incredibly broad its scope is. It's not just some guidelines for the big regulated banks. This guidance on what is and what isn't market abuse applies to any person.
Any person. You mean like individuals, too, not just company.
Individuals, companies, whether you're regulated by the ADGM or completely unregulated. If your actions touch ADGM markets, these rules apply to you. Full stop.
And their idea of a market is pretty expansive as well, isn't it? We're not just talking standard shares here.
No, not at all. It covers conduct related to, yes, financial instruments, but also things like related instruments, think derivatives linked to those primary instruments. And crucially, it also covers accepted virtual assets and accepted spot commodities. So they're really looking across the whole modern financial landscape.
Okay, that's comprehensive. But you mentioned something truly surprising before we started about reach.
Ah, yes. This is the part that really makes global traders sit up and take notice. The market abuse rules explicitly apply, even if the behavior, the actual action, happens outside the ADGM.
Wait, hang on. Outside?
Yes, if that behavior affects a financial instrument that's traded within the ADGM.
So let me get this straight. If I'm, say, sitting in London, or maybe Singapore, and I place an order specifically designed to mess with the price of something listed in Abu Dhabi, the ADGM regulator, the FSRA, they can actually pursue me.
That's precisely it. They're asserting significant jurisdictional reach. It's basically them saying, look, if you interact with our markets, we don't care where you physically are. You play by our rules. This effectively forces global firms to adopt these high standards pretty much everywhere if they want to touch ADGM-listed instruments.
Wow, okay, that's a powerful stance. So, given that reach, let's unpack this. Where does the regulator draw the line? What is market abuse in their eyes? How do you tell smart trading from, manipulation?
Right, let's start with the first big category, market manipulation. This essentially covers conduct, so transactions or orders that do one of two things. First, they might give a false or misleading impression about supply, demand, or the price of an instrument.
Okay, creating a fake picture.
Exactly. Or second, they secure a price at what the rules call an abnormal or artificial level. But, and this is key, there's an escape clause. It's not abuse if the actions were taken for legitimate commercial reasons and they conform to accepted market practices.
Ah, so intent matters. It's not just the trade itself, but the why behind it.
Precisely. The regulator is looking at the purpose behind the action.
Okay, so give us some concrete examples. Especially with modern trading, high-frequency stuff. How do people create these misleading impressions?
Well, a lot of these techniques are often linked with algorithmic trading because they need speed and scale. But honestly, they can be done manually too. First, you've got wash trades. Pretty classic.
Trading with yourself, essentially.
That's it. You're buying and selling the same instrument maybe almost simultaneously, and there's no real change in who ultimately owns it or the risk involved. It just creates this false appearance of activity, makes the market look busier than it is.
Right. Faking liquidity. What else?
Then there's layering. This one really shows the regulators watching sophisticated tactics, especially in HFT. Imagine a trader puts in multiple big but ultimately fake orders on one side of the book. Let's say huge buy orders.
Okay. Trying to signal massive demand.
Right. But the real intention is to maybe nudge the price slightly, trick some algorithms, and then execute a real probably smaller trade on the other side, the sell side in this case, and then boom, they immediately cancel all those initial big fake buy orders.
Sneaky. So the big orders are just bait, basically.
Kind of, yeah. It's about manipulating the signals in the order book.
Yeah.
And then you have, quote, stuffing. This is less about specific trades and more about just noise. Yeah, flooding the market system with a massive number of orders, cancellations, updates. The main goal isn't usually to get trades done, but maybe to slow down competitor systems, disrupt their processes, or just create chaos to hide their own real strategy within all that noise.
That sounds like it would be incredibly difficult to police, but shows how serious they are about order book quality. Okay, what about the other side of manipulation, securing that artificial price?
Right, these are more about deliberately moving the price to a specific unnatural level, often for external reasons. A common one is marking the open or close.
Why focus on the open or the close?
Think about reference prices. Closing prices, for instance, are often used for valuations, like valuing a fund's portfolio. So imagine a fund manager holding some shares that aren't traded very often. They're illiquid. Just before the market closes, maybe quarter end, they put in a buy order, maybe a bit above the current price, just to nudge that closing price higher.
So it makes their portfolio look slightly better on the official report.
Exactly. It artificially inflates the value for that reporting period. It's not based on real market dynamics, just that one-time trade.
Makes sense. What about manipulating supply itself?
That takes us to the abusive squeeze. This is where someone gets control over a significant chunk of the supply of something, maybe the physical commodity underlying a futures contract, like say 90% of it.
Okay, they corner the market.
Pretty much.
Right.
And then they use that dominant position to force others who need that commodity, perhaps to settle their own contracts, to pay a distorted, artificially high price. They're leveraging their control over supply.
So basically holding people ransom because you bought up all the available stuff.
That's the essence of it, yes. Creating an artificial price through supply control. And another quick example here is IPO collusion. Parties who get allocated shares in an initial public offering might secretly agree to buy up more shares right after listing.
Why? To push the price up?
Precisely. To force the price to an artificial high before they all start selling off their initial allocations.
Okay, so what's the key indicator then?
Yeah.
When does aggressive trading cross the line into abuse for these types?
The code points to a few things. Does the order lack a clear economic rationale? Is its main purpose really just to get others to trade or to move the price in a certain way? If the answer points that way, it's a big red flag. Conversely, if you're doing something because of a legal or regulatory requirement, that's usually okay. Motive is critical.
Right, that covers the mechanical side. But what about the information edge? The classic stuff, insider dealing.
Yeah, the perennial issue. Section 92 defines it clearly. An insider deals or tries to deal in a financial instrument on the basis of inside information.
Okay, simple definition, but the devil's in the details, right?
Right.
What counts as inside information?
Absolutely. The code breaks it down. First, the information has to be of a precise nature. This means it has to indicate circumstances that actually exist or that are reasonably expected to come about. It can't just be a vague rumor or a hunch. It needs to be specific enough that you could logically figure out its potential effect on the price.
Okay, precise. What else?
Second, and this is crucial, it must not be generally available. If anyone could find this information through diligent research, careful analysis, or even just by observing something public, then it's not inside information.
Can you give an example of that? The observation part sounds interesting.
Sure. The Regulator gives a good one. Imagine you're just a passenger in a car, and you drive past a factory that's clearly on fire. You happen to know who owns the factory, so you call your broker and say, "Sell my shares in that company." Now, you're acting on important information, sure, but it's information obtained by observing a public event. Anyone driving past could see it. It's generally available. You're not an insider using a secret report.
I see. So it's about whether the information is truly private and the third element.
It has to be likely to have a significant effect on price. Basically, is this the kind of information a reasonable investor would likely use as part of making your investment decision? If yes, and it's precise and not public, then ding, 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 it's probably inside information.
So precise, non-public, and price-sensitive. Got it.
And one more point, don't forget about trading information. Just knowing about someone else's large pending orders, the size, the price, who's involved, that itself can be inside information before it hits the market.
Okay, that makes sense. Now, who qualifies as an insider? Is it just CEOs and directors?
Oh, it's much broader than that. Yes, it obviously includes management, major shareholders, people who have access because of their job, like lawyers, accountants, advisors. But critically, it also includes people who get the information by other means if, and this is important, they knew or could reasonably be expected to have known that it was inside information.
So if I find a confidential merger document left on a train, I could become an insider if I trade on it.
If you could reasonably be expected to know what it was and that it wasn't public. Yes, absolutely. The source doesn't have to be official.
Okay, let's talk examples in finance. You mentioned front running earlier.
Right, front running is a classic example. Imagine a dealer on a brokerage desk. A huge client order comes in, let's say, to buy a lot of futures contracts. The dealer knows this big order is about to hit the market and will likely push the price up. So just before executing the client's order, the dealer quickly buys some of those futures for their own account.
Riding the wave they know is coming because of their client.
Exactly. They profit from the price movement caused by the client's own order. That's a clear breach of duty and use of inside information about the client's trading intentions. Another example, think about takeovers. An advisor working for the company planning to make a bid. They obviously know the bid details before anyone else. If that advisor starts trading derivatives on the target company's shares based on that non-public bid information, that's insider dealing.
Okay. And what if the insider doesn't trade themselves, but just tells someone?
That's tipping off, or improper disclosure. Yeah. Section 92.3 covers this. It's when an insider discloses inside information to someone else, but not in the proper course of their employment or duties. The key here is that the person receiving the tip doesn't even have to trade for the tipper to have committed an offense. Just giving the information away improperly is enough.
So a director mentioning a secret takeover deal to a friend over lunch?
Precisely. That social context doesn't make it okay. Or think about company management selectively briefing just one or two favored analysts before a public earnings announcement. That's also improper disclosure.
Right. Okay. That covers information misuse. Let's move to the third main area, deliberate deception and inducement. Spreading lies and using tricks.
Yeah, this covers a couple of related concepts. First is the dissemination of false information. The standard here is pretty strict. You shouldn't spread information if you knew, or, importantly, if you could reasonably be expected to have known, that it was false or misleading and likely to affect the market.
And this applies broadly, like social media posts too.
Absolutely. Spreading false rumors online about a company, maybe faking a takeover story, posting misleading information on forums or social media. It also covers things like recklessly submitting wrong information through official channels, like a regulatory announcement service. It's about the integrity of information flow.
Okay. And what about fictitious devices? That sounds dramatic.
It refers to transactions or orders that rely on deception or some kind of contrivance. Basically, schemes designed to mislead the market. And yeah, they often have colorful names.
Like the infamous pump and dump.
The classic. You take a position, usually a long one, in a typically thinly traded stock. Then you start hyping it up, disseminating misleadingly positive news or opinions to inflate the price. That's the pump. Once the price is artificially high because others have bought in based on the hype, you sell your position, the dump, leaving everyone else holding the bag.
And the opposite exists too, right?
Yes, trash and cash. It's the inverse. You take a short position first, betting the price will fall. Then you spread false or misleading negative information, maybe rumors about financial trouble, a product failure, whatever. The aim is to drive the price down, allowing you to then buy back the shares cheaply to cover your short position and pocket the difference.
Devious. Are there other types of fictitious devices?
Another one mentioned is concealing ownership. This involves transactions, often complex ones, specifically designed to hide who the true beneficial owner of an instrument is. This can lead to misleading disclosures to the market about who holds significant positions, which itself can affect prices or perceptions.
Okay. And the last piece in this deception category is inducing others to deal. This sounds like high-pressure sales tactics.
It often involves that, yes. It's about behavior specifically intended to induce someone else to trade, often using exaggerated, misleading, or incomplete information. Think classic boiler room operations, cold calling people, making wild claims about penny stocks to get them to buy shares that the callers are trying to offload at inflated prices. Or maybe a financial advisor who deliberately misrepresents the value of a client's portfolio in their statements.
Why would they do that?
To make the performance look better than it is, perhaps to encourage the client to invest more funds with them, or just to keep them happy based on false information. It's inducing action based on deception.
It really feels like the ADGM has tried to cover almost every angle of potential bad behavior. It's a very tight net.
It is. They're clearly aiming for a high level of market integrity.
But surely there must be some defenses, right? Especially for big, complex financial institutions. It must be hard sometimes to prove you didn't know something internally.
Yes, the code does acknowledge this complexity and provides for certain defenses, particularly for regulated firms. The most significant one is probably the Chinese wall's defense.
Information barriers.
Exactly. If a firm has effective information barriers and place procedures designed to stop inside information from passing from, say, the advisory side to the trading side, then trading might be permissible. But the burden of proof is on the firm. They have to demonstrate that the barriers were effective and that the individuals who made the trading decision did not actually receive the inside information.
So having the wall isn't enough. You have to prove it worked in that specific instance.
Correct. It's a high bar.
What about people whose job inherently involves dealing, like, market makers?
There are defenses for legitimate market roles. If you're acting in good faith as a market maker, providing liquidity according to the rules, or maybe acting as an underwriter during an offering, or even a liquidator disposing of assets, those actions, when performed legitimately as part of that role, are generally considered acceptable. The key is that the dealing is a necessary part of that function, not an attempt to exploit information improperly.
And what if you're a broker? You happen to possess some inside information, maybe from another client, and then a different client calls you up completely out of the blue wanting to trade that same stock.
That's covered too. Executing an unsolicited client order is generally permitted, even if you possess inside information. The crucial conditions are that you didn't advise or encourage the client to make that specific trade, and you didn't improperly disclose the inside information to them. The order has to be genuinely initiated by the client independently.
Okay, that makes practical sense for brokers. So if the regulator does find that market abuse has happened, what happens next? What enforcement powers do they have?
They have a pretty wide range of tools. It can start with a private warning, but it can escalate to public censure, which is reputational damage. They can levy significant financial penalties, fines. They can suspend or even revoke licenses for firms or individuals. They can impose restrictions on activities. And they can issue prohibition orders, essentially banning individuals from working in the industry within the ADGM.
And how do they decide the severity?
The code mentions several factors: the seriousness of the breach, how long it went on, the financial resources of the person involved, and very importantly, the amount of profit gained or loss avoided as a result of the abusive conduct. They want the penalty to fit the crime and act as a deterrent.
It definitely sounds like they mean business. The ADGM is setting a really high standard here.
No question about it. They are aiming for a clean, transparent market.
So wrapping this up, we've covered a lot. Market manipulation through fake orders or artificial prices.
Insider dealing, using that non-public price-sensitive information and tipping off others.
And then the various forms of deception, like spreading false news or using schemes like pump and dump.
And remember, these rules apply super broadly across traditional financial instruments, derivatives, accepted virtual assets, and even spot commodities.
It's incredibly comprehensive. And that brings us back to that point about extraterritoriality you made at the start. The ADGM explicitly saying conduct outside its borders can be abuse if it hits their markets. That really sticks with me. It poses a fascinating, almost provocative question for anyone trading globally, doesn't it?
It really does.
In this completely interconnected financial world where money and information just fly across borders instantly, how fast do global traders and firms need to adapt? Do they basically have to operate everywhere according to the strictest set of rules they might encounter, like the ADGMs, just to be safe?
That seems to be the implication. In a globalized market, the highest standard tends to set the minimum benchmark for compliant global players. It's a race to the top in terms of compliance rigor.
Fascinating thought to end on. Thank you for joining us for this deep dive into the ADGM's Code of Market Conduct. We hope this is giving you a much clearer picture of what constitutes market abuse in one of the world's key financial centers.